Happy Tuesday morning, Market Chameleons. And here's the King Chameleon, Dimitri Pargamonic. How you doing, Dima?
Hey, Will, how's it going?
Good. You want to jump right to the disclaimer?
Yep. So good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer questions and provide you with guidance.
All right. So what's the plan for this morning, my brother?
So what I think we'll do is maybe go over some features on the options chain, because I've been getting some emails. We talked about, somebody came on a show, was asking about a few features that they wanted to see on the options chain. Been getting some emails also to show existing features on there. I think we'll do that today. Of course, if there are any questions, let me know. I'm glad to take any of those questions that you see either coming through the chat, or if somebody wants to ask live, they could click on that Zoom link, come over and ask those questions. But I think the focus today will be, we're going to take a look at the options chain. I'm going to show you guys how actually I found a trade idea. All right. This is something that I did. All right. So this is something that I did, for disclosure, I have it on currently. So this is a trade that I just did. I'm holding on to it, but I'm going to give you the thesis behind my thinking, how I found the trade, how I monitored the trade, and why I did it. All right. So sound good so
Excellent.
far? All right. Before I jump to that, what I'll do is I'm going to go over quickly what's going on in pre-market hours. Then we're going to hop on to this trade. So these are stocks trading in the pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. Here I see 81 made our percentage gainers list, 197 on the percentage decliners list. So from that perspective, looks like a bearish bias at the open. I'm going to take a look at the higher market cap stocks. So these are stocks. I'm going to use the filter for stocks that have market cap of $20 billion or higher. We're going to take a look at that list and see if we see a similar situation. And one sec, I think I'll just refresh my screen real quick. So market cap 20 billion or higher. So 20 made the percentage gainers list, 78 on the percentage decliners list. So from that perspective, looks like a bearish bias at the open. So if there are no questions, I'll kind of go into, the options chain, how I found, a trade idea, what my thinking was behind it, because I do have questions, regarding that. So maybe we'll go through an example. And as we're doing that, we're going to take a look at some of the features on the options chain that you can use. So before I even start that, I had, in my mind, I already had a thesis of what I wanted to do and kind of what I'm scanning for. So let me start with that. And I'm going to go here to the option snapshot. So before, why did I even consider this type of trade? And in my mind, I already have a thesis, and it's really from my experience, from things that I'm reading, headline news, and things that, how I want to kind of be positioned at this moment in time, given the information that's available. And I'm taking a look, just to show you kind of the snapshot. This is the S&P 500, SPY. These are kind of like the different sectors here. And you can see here that this energy sector, out of all the sectors, is really booming, outperforming in the last 2 weeks. And, what I noticed is that oil prices, energy prices right now, they're moving higher, right? And if you're reading things out of China, some of the headline news, with this real estate company, they might default on their debt and so forth. That's one story. And that's one story that we've seen and may be tamed, right? Because the governments can step in, buy bad debt, they can print more money. These are things that we've seen that there are tools there to offset it, but there's a different crisis going on if you read into the energy sector. And what's happening is that to tame there's this big demand for energy, not enough. They're consuming a lot of energy, and to offset that, they're asking, basically factories to curtail what they're doing, to stop basically producing, stop using energy. And my mind, like that is not something that's easily resolved. When inflation, maybe let me put it kind of, because I have to basically first frame what I'm thinking, before I tell you, well, why am I looking for certain types of situations and trades? If we take a look at the S&P 500, right? So this is, I'm going to give you a long history of this chart, Max. Kind of looks like it's really going always up, but there are three major economic crises in the last 20 years where the government had to step in. One was the internet bubble in the early 2000s. And what happened was that was a speculative bubble. People got very excited about the prospects of the internet, and money was just being thrown at any stock that had .com in it, right? I don't know if anybody remembers it. And what happened is eventually that popped, the market started going down. So somewhere around here, you can see SPI 142 dropped to 105. You can see here 104. And people got nervous there. What's going to happen? Alan Greenspan used tools to basically inflate the market back up by taking interest rates and just dropping them to the lowest levels we've ever seen. Money started printing, markets started going back up. And what happened is that through the inflation, what they said was ease up the credit, let people borrow. Then we got into that 2008 crisis where there was a different speculative bubble in the real estate. All right. Real estate was inflated, a lot of speculation, in places, people were buying papers for higher yield, with, not realistic valuations. 2008 come, bam, the market dropped, right? We had a financial crisis. This one was worse because it was more systemic. The internet bubble was kind of contained on, on people speculating because they weren't really doing it on margin. This other crisis spread, across, internationally, because people were affected, people were buying homes, home prices were going down, people had debt, with the banks, people who had money in the banks could have been affected, people who were making other related investments. So this was much worse. So what happened? Again, government steps in, lowers interest rates, then we got new tools coming in, QE1, QE2. Anybody remember that? They just started purchasing. Instead of just loosening up the credit markets, they started to actually go in there and start buying assets themselves, propping up the market. So again, the two things here we see is that both times they use tools to inflate, right? There's deflationary pressure, they use tools to inflate. Of course, now so what we saw is, again, now we're going back up, right? 2008, they're inflating. Then we see the coronavirus. That was unexpected. What happened? Obviously, coronavirus hit, shut down the economy. Again, everything is collapsing. The economy is going down. What do we see? Again, the same tools we're using is to inflate. Right now, we got QE1, QE2. Now they're more aggressive. They're issuing checks to everybody. You got checks to companies, checks to individuals. The Fed outright just buying SPY and bond market, everything. Right, everything is getting inflated right now. And look where you're. So if those bubbles, looked hot, again, all these, now we're all the way up here, right? We're all the way up here, inflated right now, very high valuations versus earnings, and there's complacency again. So before all these bubbles hit, there's complacency, right? People felt like, well, we're all good, nothing's going to happen. We got this, some implied put. Let me go back to the snapshot here. So down here, these are the returns of the S&P 500. These are the implied volatility. So you could see here they're low relative to where they were last year, right? Subdued, moderate. So we do have some complacency right now in the market. High valuations, cheap protection. We're kind of complacent, but there's friction now going on. And my point is that all three situations, the tools that we used were to inflate. So people feel like, well, we have the tools to get out of an